Importantly, on your screen now, you can see an investment disclaimer for you to read through. Now, the highlights of this are that we don't offer advice. Nothing you hear tonight is a recommendation or indeed an endorsement. And if you're not sure about the suitability of any of the investments that we're talking about, or indeed any investment, then you should seek qualified, independent financial advice. Now, the good news is that is it for the housekeeping, and I'm going to crack on for the next 15 or so minutes and talk to you about how to research funds and trusts and what are the different options and what should you look for. Now, I should say, as when I start, is we canvass lots of research and feedback on this. We get feedback saying, Ryan, this stuff you do is really interesting, but it's too basic. And we also get feedback saying, Ryan, this is really interesting, but it's too complicated. So bear with me. I appreciate the level. It may not be for everybody. We try and get it right there, but I will send out the slides and enable you to digest them at your leisure. What I wanted to do was just talk through some of the different options that there are available for you to invest in, thinking about active and passive investing, have a little look at past performance, how useful is past performance, and then really finish up on some of the key things that is important for you to understand as you go about your investment research, and also just finally touch on how AJ Bell can help you in a multitude of different ways. I'm going to get through quite a lot. I'm going to go quite quickly. So as I say, the slides come out and it may be useful to watch back the recording of this, but I will push straight on as just a little introduction, just to talk about the different types of investment that there is. Now, tonight we're focusing on investment trusts, and as you can see on the screen, they are one type of investment, but they're quite different to another type of investment called an OIC or a unit trust, which are often referred to as funds there. A fund is open-ended and can grow to an undefined size, whereas investment trust has a fixed number of shares and you buy and sell those on the stock market, as opposed to a fund where you're dealing with the asset manager and they are creating or cancelling shares as you invest. Now, the valuation point is really, really important, because an investment trust, those we're talking about tonight, can trade at what's called a premium or a discount. So actually the value of the shares can be worth more than the value of the underlying assets trading at a premium, or they can be worth less than the underlying assets trading at a discount. The difference with a fund will always trade at the value of the underlying asset, net asset value, as it is called. Now, as I mentioned, funds are not traded on the stock market, but investment trusts are traded on the stock market. And that leads to quite an important differential in how they are priced. So an investment trust is priced throughout the day while the stock market is open. The share price may be going up, it may be going down. It's responding to the day's news and events in real time, effectively. And when you buy or sell, you know the price that you are trading at, because you hit confirm and you have bought or you have sold your units at the price you've seen on the screen. An OIC or a unit trust or a fund is quite different. It's priced once a day and operates what's called forward pricing. So when you place your order to buy, you don't actually know the price at the time that you are buying at. It's actually priced at some point in the next 24 hours, depending on the pricing of the fund. So there are a couple of fundamental differences between OICs and investment trusts. Also on this slide, I've got exchange traded funds, and now they are a different type of asset that is passive in nature, and I'll talk about that in just a second, and they look to track a specific index. So you probably hear or read quite a lot about active investment and passive investment. All of the managers you hear from today are active investors. That is, they are taking conscious investment decisions, choosing which companies to invest in, where to place the capital, how much capital to place in certain companies, with the aim of beating, hopefully, over time, a particular index. And you can see on this slide here, we've got active or passive. Passive investing is designed to track the performance of a specific index. That's exactly what it's trying to do over time, give you the return of the index, obviously minus the fee that comes with the passive investment there. There is no element of human choice in the holdings that go on there. If we think about an example, the FTSE 100, a FTSE 100 passive tracker is looking to own the 100 companies that make up the FTSE 100 and track the performance of the index. It simply goes where the market goes. If the index goes up, your passive goes up. if the index goes down, the passive goes down. You are kind of locked in for the ride. It goes where it goes. But the advantage of them is that they are cheap and give you low cost exposure to a collection of assets. Now, active management is different. The trusts we're talking about today are all managed actively, as I mentioned, and the fund manager is choosing the investments and where they place that capital. The aim is to outperform a specific benchmark or indeed deliver a certain type of outcome. So these trusts will be positioned differently to the index that they're trying to beat. And that's really important, because if they're positioned differently to the index, they will perform differently to the index. It may be better, it may be worse. All of the managers you hear from today will be the first to say that there is no way that they can outperform the index all of the time. That's just not how the markets work. They will all have periods of underperformance and will hopefully all have periods of outperformance too, which is why we've put them on the investment trust select list. So there is a risk of underperformance, but there is the potential for outperformance. Now, the trade-off there is, of course, that they cost more than a passive investment, but it's really important that you understand the differences between passive investing and active investing and accept that the outcome may be different and almost certainly will be different to the index. So what about active solutions? We hear lots about it, and so we're talking about that tonight. And really, so we mentioned that managers will outperform and underperform, and it's really, in my mind, as someone that's done fund research for more than 20 years, it's trying to understand those managers that are skillful compared to those that are lucky. Now, it's very easy to be lucky over the short term, but it's very difficult to be lucky over a prolonged period of time, as I'm sure you will be aware there. Now, managers, I think, that have the ability to outperform over the long term, I think exhibit an element of skill in doing that. Whereas those that outperform just over the short term, well, that may be luck. That may just be luck. They may have got lucky on a few companies or markets or sectors that they've invested in, and it's much harder for them to get that consistently right. What we're looking for is those managers that have got the ability to outperform over the long term. But as I said, it doesn't necessarily mean that they won't go through periods of underperformance. And to illustrate that, tonight I'm using an example actually of one of the trusts you're going to hear from. So this is the Aberdeen UK Smaller Companies Growth Trust, and this is the performance relative to the newest Smaller Companies Plus AIM index there. Now, when the line is where the bar is blue, then this trust has outperformed the benchmark, and when it is red, it has underperformed the benchmark. Now, this trust, when I put these numbers together, I realized actually it has quite an interesting pattern, because as you can see on the screen, no 2 years are the same. These calendar years going back a decade. Outperform, underperform, outperform, underperform, outperform, underperform, and so on and so on. You know, it's been very difficult as the market has rotated between all the different events that have been going on in the world over the last decade for UK smaller companies with this particular style that Amanda and the team manage it in to have had 2 years of consistent outperformance. It hasn't happened. But what is important is that when you stitch all of this performance together, these discrete calendar years together, is actually the team, Amanda and the team, have managed to outperform the index by nearly 40% over this period. Now, every fund will be different and will have a different performance profile, but I think this one does neatly illustrate that if you're investing in active managers, then you will have periods of underperformance. But most importantly, it doesn't make them a bad manager. Sadly, what we see when we analyze lots of people's investment transactions is that actually they end up selling after a period of underperformance and buying after a period of strong performance. So you'll see lots of people buying into UK smaller companies after it's had a good year and selling out after it's had a bad year. When of course, what really you should be trying to do is do the reverse, is buy in when prices are low and maybe sell out when prices are high. So I think that one is food for thought really in terms of how you go about thinking about your investments. And as ever, the most famous investor of all, Warren Buffett, neatly sums this up with a quote here. And what he says, he's got many quotes. A Google of Warren Buffett quotes will keep you busy for hours learning about his view of investing. But what he says is, in the business world, the rear view mirror is always clearer than the windshield, i.e. it's nice and easy investing with hindsight. It's much harder investing when you think about what's coming towards you. So let's just get into a little bit more detail about the different types of things that you need to understand when you are researching your investments and thinking about the right type of investments for your investment portfolio. And these things, I think, ring true whether you are a complete beginner making your first journey in the world of investments, or indeed you're an experienced investor who has an established portfolio. And the nice thing about the world of investments and finance is you never ever stop learning, and that's been true of course over the last couple of months, and it's certainly true this week again with what's been going on in the US with a couple of the banks, smaller banks in the US going bust. They're always learning events to help you think about how you shape your portfolio. But what we've got here is some key things to understand when you are researching that we think are important. And these are things that have kind of shaped my career over the last 20 odd years of researching investments and doing this job. Every single active manager out there has an investment style. They will be tilted towards a particular type of company. There are very few managers that are able to consistently rotate across different types of different parts of the market. So they may be tilted towards growth companies, they may be tilted towards what's called value companies, or quality, or a large cap manager, or a small cap manager. And indeed, the managers that you're going to hear from today will all invest in different ways and will have some of these characteristics that I'm talking about. But understanding those characteristics is really important, because it starts giving you an idea as to when they're likely to perform well and when they may perform badly. And if you think back to the chart just a minute ago of the Aberdeen UK Smaller Companies Growth Trust, each of those years is a different environment where different types of company has prospered. And what you're beginning to see is that Amanda and the team have exposure to a particular type of company that has certain characteristics, and they will do well in a certain environment. But again, Amanda will be the first to admit that they won't do well in other environments. But investment is, of course, a long-term decision. Now, we think it's important that you understand an investment manager's philosophy and process. How do they think about the world? What are they trying to exploit? How do they go about that? What type of decisions are they going to make? Is it a very well diversified portfolio? Is it a concentrated portfolio? Now, what are those core kind of inherent investment process and beliefs that are driving those decisions? So reading as much as you can about a fund manager and how they invest is really important then, because it helps you understand, give you that picture, and starts giving you a flavor as to what the portfolio should look like. Now, manager tenure, I think, is important because it shows that they've managed to navigate their way through a series of market events. I don't think any of the managers today would mind me saying that they all have a degree of experience. They've been in the markets a long time. They've seen all the things that markets have thrown at them over the last decade or more, and that shapes them as investors and shapes them as human beings. And therefore, I think that is very important. Comes back to that skill versus luck. It's much easier to analyze a manager over the long term. Now, team or an individual approach is very important. Is there key person risk? Again, the people you're hearing from today are all part of wider teams. They're not flying solo. There are people helping them with their research, backing them up with their decisions. But there are other strategies out there which have much more key person risk involved in them. Fund size is important. Is a fund too big? Is it too small? If it's too big, it's very difficult to change positioning when you need to. If you need to, if it's too small, then maybe it's expensive, and those kind of costs will eat into your performance. Or liquidity risk, as we mentioned there, it may become difficult to trade if it's too big, or indeed if it's too small. I mentioned they're genuinely active. Avoid closet trackers. By that I mean closet trackers are funds that claim to be active but actually look just like the benchmark. there, and you end up paying higher fees because active management has higher fees, but actually you're not getting a portfolio that is managed on an active basis, and you may be better off buying a purely passive strategy that looks to track an index. So again, looking at how different your chosen investment is from the index is important to make sure that you are genuinely getting active management. Now, cost is also important, but it's not just about the absolute cost, because there are certain strategies that are more expensive than the average, and they may well be good value. It may well be that it's worth paying a premium to access the investment process, philosophy, and team of a certain manager. So it's not just about the lowest possible cost, it's thinking about the value that you are getting from that. So having an understanding of the costs that come with investing, and that's a big positive. Investment trusts typically are a little bit cheaper than their fund cousins, and therefore, again, it's important to compare and contrast and see how they will differ. So I'm racing through quite a lot of information. I just want to kind of wrap that up before I hand over to Amanda as our first manager that you're going to hear from tonight. And just summarizing the last 15 minutes that I've been talking about, good managers, active fund managers do exist, but they are hard to find. There are many active fund choices in the market, but many of them will consistently underperform their chosen benchmark. So it's important to really have a good hard look at what you want to invest in. Outperforming the market consistently is very difficult. As I mentioned, every one of the funds and trusts, or the trust that you hear from tonight, will go through periods of underperformance. It's about, is that underperformance appropriate? Is it at a time when they should be underperforming, or is it a time when actually they should be doing much better? But any investment that you make, you have to accept that they will have a period of underperformance. Only invest in active managers when you think that they can outperform. So if you don't think that you've got the manager's got the ability to outperform, then do use a passive. It's a very obvious statement, but keeping your costs as low as possible there becomes important. There are more things to think about than just past performance. So again, trying to avoid this simply buying high, selling low when it should be the other way around there. So all those features I just talked about on the previous slide, they're all important factors when you're doing your investment research. I use past performance to help me understand whether I've got the other bits right in my own mind. Do I understand how they invest? What type of decisions are they making? What does the fund look like? How is it positioned? I can use performance to inform that decision making on my part, not actually be the decision in its own right. And with that, it's vital to understand how a manager invests before you give them any money. It can be very painful learning after you've invested. Well, I never knew that was a smaller companies fund, or I never knew it had a bias to growth companies or a bias to technology companies, etc. There's lots of information that's available on the internet and indeed on our own website, so do make use of that. The last point I make is just the illusion of diversification, which is all about trying to have different strategies that work together. Think of it as a jigsaw puzzle. You don't want a portfolio of funds that all look and behave in the same fashion there. So try and make sure you've got some proper diversification in your portfolio. Just to summarize that and think about how AJ Bell will help you in a variety of different ways. We've got a huge universe of investment solutions on our website if you're confident choosing from them. We also have our favorite funds list and our IT investment trust select list if you need a little bit more help with your research process. So again, lots of information on our website. If you're not quite sure where to start, then we have a range of pre-built portfolios based on your risk appetite. They're called our ready-made portfolios. You'll again find information on our website about that. And finally, if you really don't know what to do, investment research isn't for you, you're bewildered by the choice and the complexity, then we have a range of our own AJ Bell funds that are invested, that do the asset allocation, do the underlying selection, and charge very low charges for that. So all of this is available on our website under the investment ideas section. Hopefully there's something that resonates with you and can help you on your research journey and indeed your choices for your ISA for this year.